Oh, we are live. Mic check, mic check. Fantastic. Good evening, everybody. Good evening, everybody. I just want to quickly let people in the public Telegram group know that I'm live, and then we'll start. This is going to be quite a short video, which I'm pretty sure. Sorry about that, which I'm pretty sure would be very much appreciated. Most of my videos are quite long, but I was reflecting a lot about what happened this weekend, and I was just pumping around market information, market crash, and we have had a substantial crash for the last about 3 weeks. Tech stocks in general have been bleeding. Nasdaq, SP 500, Dow Jones, etc., etc. So it was a very, very good idea to cover that so that people know exactly what to do. But it's also really not part of my vibe. I just felt like a lot of that stuff was a little bit too negative. And if there's a market crash coming, then the content is there's a market crash coming, right? I won't change that just to sound positive. But I'm saying it's very, very important that I give a very balanced perspective, and especially with me, because I love living a very positive life, but you can't just be blindly positive in the markets. Now, yesterday, because of all these reflections, I decided to then reflect, on the war rooms we did, and I thought, after giving out all these facts about the markets, it would be great if I can also find light at the end of the tunnel, and for me, that is to correctly talk to the fact, at least about where I think the markets are going to start to bottom out and start to recover. And so signals. So I want to talk about potential signals to look out for that would show you that it is now surely the end of the market crash. And that is, neither here nor there. But I'm going to go walk you through a couple of things that I looked into today. So I pretty much spent most of my day doing this. And they're just very important things to look out for. I will also in this video touch on the Fed with what I think happened in the Fed meeting. I'll touch on those of you who are aware, Bullard was talking at 6 p.m. today, so I had to quickly listen into that, and then just kind of like put all these thoughts together in about 30 minutes. So thank you for rocking with me. If this video helps you towards the end, please don't forget to like, share, and subscribe. And let's rock. Right, guys. So for the most part, I've been quite clear about where I stand, right? So you can see today is Monday. We have some type of, Nevada is strong, right? It's a very good company. It's kind of like holding and pulling together. Google is strong today. It is not like exceptionally strong, but 1+% from the depth, is perfect, right? Facebook is still struggling at minus, 59%. Amazon, Tesla, right? So Nasdaq should start to receive the boost it needs. Look at this, Netflix. So your mega caps, remember your mega caps were decimated during the stock's earnings report. It was only Amazon that actually had a positive reading, and that positive reading was exacerbated and over celebrated by the markets because markets had arrived at a point of maximum pain. Look at the change of money. If you followed my videos last week and I pulled out this a screener for you, oil and energy were the only good green things over the weekend and on Friday. Now, oil and energy is what's currently dropping right now. So look at that, -2%, right? Your ExxonMobil, your oil and gas, -2.3%, right? So there's a change of money, right? Money is coming out of here and moving back into there. And I want to kind of like, talk to you about the reasons why. And also, fundamentally teach you how I get to this point, right? A lot of this stuff is going to be new to you. That's cool. All right. Your job is not to panic and just have an information overload. Your job is to just take it one step at a time, right? Nothing is hard. It's just new. I'll just keep showing up, every week. And at some point in time, you will understand immediately where my mind is going, right? I'm not always right. I think that's a very important thing to keep at the back of your mind. Right, so quick recap. This week or next week, right, in the next 2 weeks, but preferably this week, Russia needs to make a move. All right, if Russia doesn't make a move, then markets will continue to feel a sense of relief, which is a good thing. Because when Russia doesn't make a move, then we don't get war. All right, so preferably this week. And there has been an update, right? So there's some diplomat literally from the Ukraine who said the product plan for Putin, and the plan was basically that there was going to be some rollouts and this and that and this and that, and basically Putin said okay, he okayed the plan. Okaying the plan, the markets took that as a signal that it is very possible to talk themselves out of this situation versus fight. So there is a glimmer of hope, number one, a glimmer of hope that there might not be a war, that we can completely avoid a war. And guys, this is what we should all be praying for. War is a nasty thing. All right, so that aside, stock markets are slowly starting to kind of like recover and feel a little bit revived from that. I'll show you quickly the Nasdaq chart because I find it so interesting. If you remember, we called this in our previous forum. I told you guys that I'm not buying. I did tell you that there were a lot of 365 traders who had set some pending orders at about 14,100. And with mathematical accuracy, that's exactly where price started to recover from. How did we know this way ahead of time? Yeah, that's up to you to come learn, right? So there it is there. This is where price started to bottom out inside this demand right by 14,100. All right, so that's amazing for an accurate trade call. Then in the war room, I said, if you're in these buys, short-term buys, you might want to negotiate with your inner self to take profits here at about 14,600, 14,500 in the touch of this trend line. Or you could be brave and wait to see as markets seemingly start to collect good news every week. So every day this week, right? So you could decide, you know what, you're going to give it a try and see if you can climb back up, right? Remember, when we're climbing back up, we'll be facing a series of supplies. And so we need to confront those sellers like me, like I'm a seller. I have one big sell position on my corporate account, no buys or sells in my personal accounts. But there are some heavy sellers who are going to be looking to sell these rallies. So this is very much still at play right now. I'm not saying we're out of the woods. I'm just simply saying markets. So we only know that Putin agreed to a plan today, but on Saturday and Sunday, before we even knew there was these meetings, through our trading strategy, we knew that Nasdaq was going to bounce back at 14,100. In fact, we've been talking about this level for a very long time. I mean, there's a guy called Trevor from Botswana in the Academy. He can vouch for this. We've been talking about this for weeks, that we're going to buy at 14,100 again. And those of you who've been patient, price has come back to you. Those of you who bought at 13,800, it's time to start sacrificing and praying that this rally continues. All right, so that's update number one, that there's some type of good news, and you can see that the markets are responding to that. Fundamentally, we know that oh, fantastic. This is what it looked like before opening today, right? Before markets opened today, Google was -3, Facebook -3, Amazon -3, Tesla -4. Look what it looks like now, right? A massive change, right? A massive change, right? So this is good news, and we should see it as good news, right? Not enough for me to make a long-term swing trade on, but good news nonetheless. Now, if you look at the US stock market, and this is now me walking you through how I'm thinking about predicting the bottom of price, which is also called timing the market. And a lot of financial analysts will tell you timing the market is nothing short but of a terrible idea. You don't want to time the markets, but as a trader, you kind of forced to, because we are thoroughly engrossed in complete market speculation. I'm just going to give you guys a full cinematic view. If my audio cuts, let me know. Those of you who are on the live, I've just done something to my stream there. Just please double confirm if you can hear me. I know, can you hear me? I know I didn't even do an audio check. I just started talking, but just can somebody, just one person on the stream, just double check, confirm that they can hear me? I know there's a 10-second delay. I'll use that to catch my breath. Just need one person to say yes, they can hear me, but let me just continue talking, and I'm assuming you can. Yes, fantastic, my brother from Dubai, if I'm not mistaken. Right, so look, man. So I'm thinking about markets, right? I'm like, okay, fine. Let me look at the US 30, because the US 30 is a really perfect aggregate of the actual state of economies, specifically the United States, of course, but is a very good indicator of global economy. Okay, thank you guys. Thanks, David. Very clear. All right, I'm happy. Thank you guys. Right, so now, and because historically, the course that I put together, supply and demand course that I have, you must realize that for me, fundamentally, I learned how to trade through studying the 2008 crisis, right? So when I joined the ITPM, International Traders Portfolio Management, under Antonio Creel, most of those Goldman Sachs gurus literally were made millions and billions from financial crises. So I feel like it's a good edge to have, right? Like anyone is a genius in a bull market, you just buy and hold. But it's when you have crises or bear markets where you need to learn how not to catch a fall in life and where to start building again, right? So I was trying to figure out, a couple of patterns, if I can figure out a couple of things. And you see this big slump here is the obvious one. It's COVID, right? And the other, and I'm thinking in the last 5 years. So in the last 5 years, the other, and maybe if I can come 5 years here, but you'll see it anyways. The other big, oh man, slow internet, right? The other big crash was in 2008. This one here. This one here, there, this deep gorge here in 2008, which was very much coupled with the COVID crash. So here in 2008 and here in 2020 COVID. And then the next thing that my mind needs to get to wrap its mind around is, well, if that's the case, how on earth did I start thinking about buying during 2018, which I was quite active in the markets then. I wasn't as polished as I am today, but I was very active in 2018, 2019, and obviously 2020 COVID. I was extremely public with my academy, etc., etc. And what I did do was go back to all these big indexes. Now, those of you who've been trading for a very long time, I don't know if you're part of that crew, but one of the indexes that made me a lot of money in 2017, 18, and 2019 was the Russell Index. Nasdaq wasn't as popular in my circle, right? In my circle back then, as Russell was. My first six-figure long-term trade from indices was the Russell. I always tell people 365 came from after losing, for almost 3.5 to 4 years. And I finally did a series of proper education on markets. And then I decided to spend 1 year just practicing how to swing and position trade. One of the buys that I did was on Russell to 2000, and I just held it for 365 days, and the profits for that changed me and my family's life forever, and that gave birth to the 365 Trading Academy, because I got out of debt because of this one long trade. It was a positional trade. It was perfect. It finally made sense. So I remembered why I'm very smart financial analysts come back to the Russell. It's absolutely interesting, right? Now, the Russell, guys, is made out of small cap stocks. Small cap stocks. That's point number one. So things like Nasdaq, right? That's a mega cap, right? In fact, Nasdaq is a grouping. So let me talk about individual stocks. Things like Amazon, mega cap. Facebook, mega cap. These are like billion dollars worth of companies. Netflix, mega caps, right? I mean, Facebook is down, but like tremendously. I won't even waste your time with this chart, or maybe I should, so you can see it, right? And we should probably start trying to move to calling it Meta. Look at Meta. Meta / Facebook is, man, see me and this paintbrush. My charts are always a mess. Charts are always a mess. I promise you guys, I don't have a lot to say. I'm only here for about 20 minutes, 30 minutes, 8 p.m. Valentine's dinner. Well, actually, I've got to do another video for something completely different. And then I've been allowed to be busy until 9 o'clock. Right. So this is still fundamentally a massive company, right? It's still, I think the last time I checked, they were sitting about, where's that stuff? I never know where to find it on TradeView. Okay, fine. I'm going to move on. But they're technically just under $600 billion US dollars, despite losing almost 38 to 40%, right, in poor stock earnings report, right? So this is actually a very big deal, right? They've done 42% drop, almost like Alibaba. If you guys remember, Alibaba was the first big giant stock to fall last year, based on the Chinese, crackdown, right? But this is interesting. All right, so there you go. See, Wall Street eyes lower open on rate fears, and Ukraine tensions ease slightly. So this is what I was referring to earlier on, where I said some diplomats just said, look, man, Putin has kind of like agreed to a plan, etc., etc. Now, it's difficult to use these mega cap stocks, the big companies, Facebook, Amazon, etc., to get a clean reading of the markets. What I like to use, and what I've always used in the past, and what I believe smart financial analysts love to use, is this stuff here, the Russell 200, because these are small cap stocks, right? Small cap stocks, which mean they're extremely sensitive. I want you to hear me now. They're very sensitive. So you will always find, when a crisis begins, the Russell will be one of the first stocks to fall rapidly. And I'm talking dramatically. Like if Nasdaq is down 1% on the day, Russell will be down 6%. If Nasdaq is down 3%, well, guess what? Russell is down 10%, because they feel the impact severely. But if you study this chart that I just showed you, which I'm sure I've lost, okay, it's already gone, though, the one I had earlier on, where with the history of the stock market, the 2020 crash, which is this one, you see this, March 2020 there, right? This is COVID. Look at this. And on the other side here, this one here, this is the 2018 crash I'm talking about. If you study these two on the H1, H4, etc., and you go through that data, which took about 6 hours to do today, I guarantee you, because it's small cap, Russell, when markets are starting to find a bottom, when markets are slowly but surely starting to find a bottom, when a recovery is near and dear, Russell 2000, right, because of the type of companies that make it, start to recover first. So when Nasdaq is trying to be up, say 0.35%, normally Russell will be up 2%, etc. So they lead the recovery, and they also lead in the decline. Now, last week, unfortunately, I just write a lot of things down, and I don't know how best to go back. But if you've got the CNBC app, which I know a lot of traders have, I actually don't even use the app. I just come peruse here and then I bounce. But if you've got the CNBC app, you'll always see, Dow, S&P 500, Nasdaq, Russell, and then the fear gauging index, the VIX, right there. And last week, everything was down. I promise you, everything was down except for Russell. Russell was not down last week. All right, and then today we've got almost like a normalization where Nasdaq is really slightly ahead, and Russell is starting to just kind of like fall back and catch up. But a whole of last week, when markets were bleeding, Russell was one of the few things green. Now, that's not enough for me to assume that, the drop has happened and that markets are about to bottom, but it is enough for me to start getting very interested. I start getting very interested. So if this continues up until Friday, right? So if every day during market open and market close, I come back and I see Dow still red, SP 500 is still red, but tech stocks are kind of okay, and Russell is green, I take that as a good sign. If that continues for 2 weeks, last week's already happened, and if it happens again up until Friday, where Russell can keep its head above water as those small cap companies start to normalize, right? It's a very good indication, right? I'm really starting to think, okay, fine, slowly but surely, if Russell starts to outperform, right, these big guys, slowly but surely, mega caps, those gigantic companies will also be now starting, their road to recovery. This is not to say the crisis is over. It's more to say, all right, there is a bottoming up process happening where these things are starting to find a bottom, and a bottom means, okay, fine, we're at a sharp fall. Let's now level out. Let's create a base. Let's start to market. Let's start to get some buyers. Market meaning send out good news into the market, and then start a value-based recovery. That's how you get a V-shaped recovery. From a technical perspective, Yes, I'm very worried because right in front of me is still an extremely bearish sign. We're not out of the woods, guys. But look at this chart. Look, I mean, just look at the Russell index on the monthly. It's so different from something like Nasdaq or SP. Let me pull out the Nasdaq for you. Let me pull out the Nasdaq for you. You see what Bitcoin is doing as well, right? Bitcoin is literally coupled with the stocks. It's acting like there was good crypto news today. Nah, it's just mirroring smart money. Right, so this here is Nasdaq that I'm going to pull out for you right now. I'm going to give you guys a monthly perspective of the Nasdaq, and then I want you to see what did I just do? I pressed the wrong button, and now I don't know. Okay, let's do this. Sorry, guys, and then let's do that. All right, there we go. So on my right here is Nasdaq 100, and I want it on the monthly time frame. Right, there we go. You see, and this is a very sensitive primary market. Why? Because it's made of a lot of mega caps. Look at this sharp fall, bearish engulfing. The wick has already been filled, or is pretty much been filled by the month of February. But when you look at the Russell, right, you instead of this peak where prices really short base drop, you actually get an evening out, right? So markets are on the Russell, because of its sensitivity, literally start to consolidate. In the academy, this is a big sign for us. We like to see stuff like this, right? This is our Talitha area where markets just pause. This is not something that happened overnight for the stock. This is like, I'm talking March 2021. Banks move in, think in 3 months, take profits in 1 year. This is April, March 2020. 1 year, and look, profit taking is delayed. There isn't a drop. There's absolutely no drop. Instead, there's massive consolidation. For the rest of 2021, the Russell didn't want to move until very recently in January, when things go a little bit crazy. And I've covered what was going on in December in previous war rooms. But I find this absolutely interesting. Now, the only thing I'm worried about when it comes to this chart, like I said, is that from a technical perspective, there's still a lot of signs for downward movement. And again, I'm not here to talk about wars, right? But if there was a war, this is at play. But in the event there isn't a war, that's what I'm here to talk about. If the war fear goes away, you must remember, markets were not crushed by the war. Markets were already heading down. Markets are terrible stock earnings. Markets are suffering from inflation fear. Markets are suffering from massive CPIs, right? Confusing job reports, ADP minus 300 jobs, NFP plus 480,000 jobs, right? So the markets are dealing with a lot of uncertainty. Hey, brother Sarid from Namibia, good to see you, man. The war was just a cherry on top. So I'm thinking if the war goes away, and I'm hoping it does, we still have a lot of problems to address in the market. And I'm saying I come to the sensitivity of Russell to kind of figure out. I was able to predict correctly. Those of you who were with me last year, this bottoming out process in 2018, it happened the exact same way. And I'm pretty sure this is going to be my temperature gauge, right, for the year 2022. All right, so that's one big thing. And at the end of this video, in the next 15 minutes, I'll then tell you exactly when I think stock markets are going to actually start to show a full-blown recovery, and if I'll be right or wrong about that. Now, a couple of things to consider while we're dealing with all these things, because the Fed did come out today and tell us a couple of shocking things. One of the main shocking things, which I'm so perplexed about, right, is it's typical, it's ironic, it's political, and it's got nothing at all to do with me. There's absolutely nothing I can do about it but accept it for what it is. I've got so many tools out here, and I'm trying to get my whiteboard out, but it doesn't want to come out and play. Right, but for the most part, the Fed came out, guys, and the Fed told us some shocking things. So not shocking in a bad way, but just shocking in terms of logic. They are still printing money. QE is still going on right now. So if you notice, we've been talking about QE since last year, November on the channel. QE is the main thing that helped us recover from COVID. And I say us, I'm talking about Americans, but really global economy, because it saved the dollar. It put money in people's hands. People could spend to save economies. People use that money to pump money into Bitcoin. And so people like me in Africa also benefited because people had money, because QE means the Fed is printing money and putting it into people's hands. The Fed got worried about QE and its impact. So in November, we started tapering. Tapering is a two-pronged process. Number one, you reduce government purchases on bonds, and also you start to reduce month to month, etc., etc. We thought, and it was told to us in a way to allow most of us to assume that printing ended immediately, right? And it didn't. Technically speaking, they've been slowly reducing how much money they are pumping into the economy. So that's still a good thing, but it doesn't mean complete printing is done. Right. So what the Fed did today was be very clear and honest about it. Right. So they said a couple of things. You guys have no idea how I've missed my whiteboard in this war room. So those of you who know me, you know that if I don't have a whiteboard, I start to talk too fast because I'm thinking way too much. Right. So the first thing that they brought up is, look, man, they've lowered, right, monthly purchase, which I think is quite cool and very important, and in the direction that we want to see, by $20 billion US. So in terms of state assets, they've actually reduced this, right? Yes, they are still printing money, but they are also tapering, right? Lowering monthly purchase by 20 billion is good. It's good because you're still tapering, but they're still printing money. They are reducing how much they're printing, but here's the real bullish stuff. Bullish for the American economy, bullish for the dollar. They were very specific. March the 10th, mark this date, write this date down. Remember this date, March the 10th, all printing stops officially. This, guys, is not a coincidence. Now, I always tell you guys, you know, markets are a game of those with the most money, and all they do, they simply manipulate us in the direction in which they have, and that's pretty much the gurus in Wall Street, hedge funds, etc. Your job as a trader is to just play the game the way they do. We're not here to change the game. Well, there's no revolution in the financial markets. You will lose your capital. Do what they do. This is why we use supply and demand. Now, if this is done, and it's now a done deal, it's public, it's legislated, printing actually now stops on the 10th of March, which now also means, because last year, November, if you remember correctly, tapering was going to take about 7 months. That was going to be November, December, January, February, March, April, May, June-ish, right? Tapering now officially, all tapering officially ends March the 10th. That's interesting. So guys, they're building up. These guys are in a rush to increase interest rates. Like we thought today's surprise secret meeting, they were going to announce potentially to increase the interest rates, but all they've done is they've sharpened, right? They've sharpened the eye on the price, because Powell did say in November, and I actually found a video on my YouTube channel when I kept saying it, that it's difficult for me to believe in economics if Powell is going to do this. You can't taper and at the same time increase interest rates. There was fear that today they were going to announce a secret increase or immediate increase, but Powell was clear that we first complete the taper, then we can consider interest rate hikes. He said this in November, and now they've put an earlier solid date to end the tapering, which is 10 March. So printing stops on the 10th of March, but tapering also ends on the 10th of March. Once all this is done, this means all of a sudden, these are the steps. I want you to get this. All of a sudden, the beginning of monetary tightening starts, right? So the opposite of monetary tightening was that QE, quantitative easing, printing money. Now, monetary tightening is removing money from the economy. Monetary tightening is slowing down, the economic hit. And I believe, and as we all know, the only way to do that quickly and effectively is an interest rate hike. Now, if you're in South Africa, Dubai, Kenya, Namibia, Botswana, where else are they? 365, Philippines, across the world, wherever you are, Every single country is a Reserve Bank governor whose job is to monitor monetary tightening. And you'll hear them say, we are increasing the interest rate by 0.25 basis points. Or generally, and this is the norm, this is the normal one, or rarely on odd occasions, they can do this, 0.50, half, or they'll say, you hear CNBC say half a basis point, right? That means it's more. They increase the interest a bit more, right? This can go on and on. You could have 1 full point, right? That's rare, but in a case like hyperinflation is possible. You can start to see these things if you study the markets during financial crises, specifically 2008, Great Depression, or any other time period where there was massive recession. So there's an interest rate hike, and the normal statistician and economist is looking at 0.25 or a quarter of a basis point, right? And that's what a lot of people might be thinking about. Now I'm thinking, and I'm trying to find, when will this crash end, right? That's all I need to know for my portfolio. When do I think it will end? I've got printing coming to an end, tapering coming to an end, which means monetary tightening is starting. There wasn't an emergency interest rate hike today because it's not yet the 10th of March, which is fine. And I'm thinking, given this thing that I've been drawing on my charts, there's a lot of inflation in the economy. Well, I've explained this. I won't waste my time on this right now. And we've said prices have been going up in the economy. Things are getting more expensive. Leroy, how do we know this? Look at CPI. If CPI is positive, then prices are going up. But what did we get last month, Leroy? NFP. Not only did jobs go up, which is important, but remember, I told you guys, start also looking at wage increase. Because remember, if wage increase is going up, then the price of food has to go up. But if the price of food is going up and wages need to go up to catch up with the price of food, the real problem is inflation, which is what the Fed is here to fight and defend. Now, given that the annual, right, so if you look at the CPI, there's a CPI projection, which I'll show you, but the annual CPI right now is 7% annually. Let me not even say something that I'll show you and then not show it to you. Let's remove our whiteboard. Bye, whiteboard. Thank you so much. Right. I want to show you the stuff. We're almost done. We're almost done. But I love markets, man. I could literally host a stream every single bloody day. Literally. Ooh, not bloody. Every day. Every day. Right. So check this out. So this is the consumer price index of January 2020. You would have all received a very short version of it in the news release. And I was going through this stuff and I was just combing through it, and I found this interesting, right? Look at this. This is 7%, 12-month percent change of CPI. So January 21 to January 2022. All right. And we all know what, like, in the month of this thing here, like, and look at this, right? So that's 7%. And if you look at our curve, at least last year, right? Last year, this is where we were last year, right? We're just chilling somewhere there. If you think about February 2022 compared to February 2021, this is where we were. And now we are already up here, right, at 7%-ish, right? Remember, we're going to have to wait for the next CPI reading to give us, the range for this coming month, February. So on March, we're going to get CPI data to let us know where we are in February 2022. Some of you guys always want to know why I'm always right about news events and don't even care to trade them, because I do this kind of research. I do this kind of in-depth research. But you can see, right? You can honestly see that this inflation thing is a real problem, right? Price for almost a year now, nonstop, has been moving relentlessly. You'll remember in June the 16th when FOMC increased interest rates, right? If you see our DXY chart, we got a flattening of this curve. That was important, right? We got a cool down of inflation. So they want to do something like that somewhere up here. And that is if they increase the interest rate, right? So I'm going to move away from this chart. It's just, I want to show you the stuff in case those of you want to go deeper can, right? This is where you get it. Bureau of Labor Statistics, and they release it all the time. I don't pay anything. It's just a free PDF, but it's got a whole lot of good information. If you don't understand it, stay tuned on the channel. I'll just keep coming back to digest, all of this market information. Right, so a couple of things I've laid out clear because I'm building my case. So inflation, personally speaking, I think inflation is going to be high as well. So if I come to a Forex factory, right, which would mark out all our news events, let's quickly rush to March. And let's look around March the 10th. Why is the Fed so obsessed with March the 10th? We're ending printing on March the 10th. We're also stopping tapering on March the 10th. What on earth is there on March the 10th? Well, there's March the 10th. Interesting. On March the 10th, there's another CPI data announcement. Ladies and gentlemen, the market manipulation and the perception of the market is being formulated. Remember, Powell doesn't care about retail traders. He doesn't think you're important. He doesn't think you and I are important. We are too small. We are too little. I have 6 trading accounts. I can combine them, and there's a lot of money in my 6 personal trading accounts. I have 3 other accounts on top of that, which are my corporate accounts that I trade for companies. And those are really, 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 really big. I'm not bragging. I'm just saying if I put everything under my name, under the sun, under my academy, that money is very little. Powell doesn't care. Powell is planning and starting to formulate a narrative to the movers of money. Who are the movers of money? Wall Street, hedge funds, institutions, central banks. He is building up a case. Look, so now we've got a serious, heavy expectation for March the 10th. A lot of things are building up for that because there's going to be CPI data then. And straight after all of this happens, I'm pretty sure he's going to show up the following week to then talk to these points, right? The following week, there is the FOMC statement, FOMC economic projections, and that is March the 16th, where I said I thoroughly believe with all my heart that there will be a big change, right? An interest rate change will be announced between 15th and 16th of March, right? It's just almost undeniable that it is going to happen. But because I'm Santa Claus today and I'm giving you guys some cool tools, if you come to investing.com, all right, you come to investing.com and you just type on Google Fed rate monitor tool, it'll take you to investing.com, right? So this is also, I don't know, no, see, this is all free. I'm not even paying a single cent on the Investing Pro account. So you can get this on the free version of investing.com, right? And I haven't double checked to see if I'm sharing all my screens. If I can just quickly make sure you guys can see what I see, I'll be with. All right, fantastic. Yes, you can. Right. So if you come here, given what happened this morning, now this is weighted index of what professionals believe. So licensed traders like myself, institutional market financial analysts across the world, and check this out. So this is the basis of point, the stuff that I draw on the whiteboard. These guys believe that on the 16th of March, all right, on the 16th of March, there is a 64% chance that the rate will actually, they won't go 0.25 or a quarter basis point, but the majority of analysts are also thinking, look, man, things are so bad, the Fed has to act this way on March the 16th, has to increase the interest rate hike by at least half a basis point, 0.50, to almost 3/4 of a point, 0.75. So somewhere in there. Now, how this works, just so we're clear, because I don't want you guys then to start coming to look for data and then just assuming that markets are going to go your way because that's what's said. That is all speculation. That has nothing to do with what the Fed does. The Fed does what it wants. But if 64% today on Valentine's Day are looking at an interest rate hike of 0.50, right? That's a good number. The problem is when this number by the, I don't know, the 10th of March, 11th of March, 12th of March, the Fed comes back and sees that 99% of the market expect the Fed to increase the interest rate hike. The Fed is not going to want to rock the boat that severely. Because remember, if the entire market is expecting price to move on one side, the only way to make the most money is to go the opposite way, because everybody gets a short squeeze or a long squeeze, just depending on the direction. So what you want is a healthy demarcation like this, a healthy indication This allows the Fed to almost dance to the tune of the market that he sets, because I guarantee you they look at this number and say, this is what the market wants. It's a healthy outcome. Let's do it. The problem is if we're too edged to say all of us want this, and the Fed goes at 0.25%, which, by the way, would be an interest rate hike, the market will interpret this as a massive bearish signal, a massive disappointment. Yes, we got an interest rate hike, but it was too small. We all expected 0.05, 0.50, and then markets will tank, right? So the Fed has to kind of like navigate this dance, in a very, strategic way. But for the most part, as you've seen for yourselves, if I can remove this again, right now, I think this is quite a healthy number, If this number was below, so let's say 64%, where we're sitting at about 25, etc., and it wasn't looking good. For example, I can't go back in time, can I? Can I go back in time? Okay, no, it doesn't matter. But in this example, let's say more people thought it was just going to go up 0.25, then the Fed would do what it did today. Today at 6 p.m., I don't know if you guys noticed or if you watched it or if you cared to watch it. I did, because I just find, how these guys play this game quite interesting. This guy will show up. FOMC member Bullard is hawkish. There are FOMC, there are about 8 or 9 of them who sit with Powell, the executive, the round table, whatever you want to call it. Some of those guys are dovish. Some of them are arguing for keep printing money, don't shock the market, don't quickly change things, because it will cause massive shock in the markets, right? They are very dovish. They want things to take their time. And then Bullard really, and some other members of the FOMC are extremely hawkish. Bullard is hawkish. He is just the king of hawkishness. Anytime Powell, the FOMC, needs the market to start to anticipate interest rate hike, strong dollar, he sends Bullard, because Bullard goes, we need 1% interest rate hike. Why would you want this? Because the only thing, ladies and gentlemen, that moves the markets is money. So you want to create a market environment. The correct term for that, let's go with sentiment. You want to create a market sentiment before it happens, for the markets to slowly but surely start to anticipate an upward movement. When the markets start to anticipate an upward movement, what does smart money do? What do investors do? What do billionaires do? They back the horse. They start to put money behind that anticipation. When you do that, then for sure, small fish like Leroy also start to buy into the narrative that the dollar is going to be strong, start to buy into the narrative that potentially interest rates are going to go up. All right, so that's how this game is played. It is well coordinated, guys. It is honestly well coordinated. This guy, why make it a public thing? Why go on CNBC and share some closed meeting ideas? Because you want to control markets perception, right? Markets are controlled by Wall Street, right? So for the most part, I think that is everything, to kind of like update you on. Now, on the table, all right, on the table, you have the following things as I wrap up this thing. Promised you guys only 30 minutes. On the table, we've had for the last 2 weeks the Fed and the amount of uncertainty that came with the Fed. We've had the Russia nonsense, right? And the war, caps locks or no caps locks, I apologize, with the inflation crisis, which we know is no longer transitory. Inflation is a big problem. We've had worker shortage, according to ADP, right? Which we know, well, according to the government, was bullcrap, according to NFP. We know these things. We've had our mega cap companies, Facebook, Meta, Tesla, apart from today, Google, do terrible. Netflix, mega. I'm talking about companies that are worth $100 billion and up, all right? Because the stock market is nothing just but a couple of trillion dollars. And so these mega caps are massive contributors to that stuff. We've had them suffer. And then since last year, we've had supply chain problems across the world because of COVID and ships. Now, this is the bad. The bad is facing the following things, which I found quite positive today. which helped me come to my speculation. Number one, we know what the Fed is actually doing. 10th of March, tapering comes to an end. 10th of March, printing stops. 10th of March, we're going to get this magic CPI data. It's going to tell us what we already know, right? It's going to be positive as far as I can tell. You know, prices are going up, etc., which means the dollar is going to be strong that day, etc. It's going to be the final report to encourage the Fed to increase and go with the rate hikes on the 16th of March, the following week. This to me looks very clear. Like, I'm no longer unsure. I'm very sure about my course and how to move my portfolio with that information. Now, outside of all of this, we have oil starting to tank, right? And it could just be for the day, not just oil, Brent oil, not just Brent oil, all your energies. So even natural gas took a beating. Now, one could play devil's advocate as I conclude. So I was doing some research, and I found this article, you know, from BBC. In Russia oil, this was last year November, when FOMC is busy tapering. In Russian oil and natural gas provide both wealth and deep national pride, with global demand for fossil fuels set to decline. So, God, listen carefully, guys. There's been a call for fossil fuels to stop. In South Africa, I had to join this work group because I was doing some research on trying to find green ways and how to improve labor in the South African economy and how to go green. And there's a whole big talk, and I had to understand and learn about fossil fuels. And it was an interesting project, but yeah, it came to an end. Now, there's global demand for fuels to set to decline. How will Russia adapt? Now, I'm thinking, you know what, you know, there's a lot of cool information here, but let's come here. Now, oil and gas make up 80% of whatever, however you pronounce this economy, right? 80% of Russia's economy. Overall in Russia, oil and gas provide 39% of federal budget revenue. That's a lot of money. And made up 60% of Russian exports in 2019. Russia's entire economy is based on oil and gas, right? Fossil fuels. Russia absolutely needs this stuff. Now, if I was Russia, and I was very much well aware that I don't want to kill a lot of people. I don't want to be like a Hitler, you know, and start another nuclear war. But I know that the threat of war drives oil prices up. The threat of war pushes energy prices up, which means I can quickly pocket, because this fight honestly started off a stupid agreement with NATO and all that stuff. I can literally extend this into recession areas at $100, which is what I've been telling you guys since last year they want to go. If I was Russia, it wouldn't be a bad move to huff and puff. If honestly speaking, my entire economy runs on this, because remember, the moment you threaten Ukraine, right, oil prices, because of what Ukraine provides, the way the pipes work and the connectivity, etc., these things naturally have to go up. These things, he doesn't have to go through with the war, but he has to create enough market uncertainty for pumps to go and prices to go up, right? Will there be a war? I don't know, but I know the only person making a whole lot of money by the very idea of a war existing right now is Russia, right? Russia. So I thought this was actually quite a cool article to also bring to your attention. I've shown you guys this stuff. Look at this SP 500 also starting to slowly recover. So we're waiting for the Dow, right? But I'm pretty sure it will pick up. I'm sure it will pick up. The last thing as I close for real is please do not forget the principles I taught you in the course here, week 1, week 2, and week 3. And these principles are quite simple. We generally know where price is going all the time because markets price in everything. Well, I mean, if you go through the course, you'll know what I mean. I'm going to keep this nice and short. Markets price in everything. That tool that I showed you on investing.com, the Fed is starting to price in a market anticipation hike. But we have known this since June the 16th, when the Fed used an interest rate hike on top of a DXY monthly demand to start a long uptrend. Markets price in everything. So you need to operate with that knowledge. Price has priced in a lot of things. Fear has been priced in. All the negative things that we've been talking about, that fear has been priced in. And I promise you, if we are too negative, too panicky, too market crash, and we must talk about it, right? What's going to happen is we are going to find ourselves trying to sell at the bottom of the barrel, because markets know when to start turning. This is not a random thing, right? That's the whole point of our course. Markets are not random. Absolutely nothing is random in the trade. One thing that no one is talking about, but we cannot forget, is the impact of the last financial crisis, Corona, and where Corona stands in 2022. We know that there are many states now across the world, but specifically in the United States, where wearing a mask is no longer necessary. Right? Remember, we just had a terrible stock earnings report around all these stocks, right? And that's because a lot of it, they suffered during COVID. They suffered during lockdown. They suffered during lockdown and COVID because of supply chain, because you couldn't ship all your chips in and your extra raw materials. You couldn't order all your Tesla parts on time because of global lockdown. We are moving out of this old order that was started in 2020. More states are removing masks, so very soon, and in my humble opinion, by soon, in the next 2 to 3 months, countries like America, and across all states, I'm pretty sure masks will be a thing of the past, right? The thing of the past. We'll start to see the headlines talk about, mass herd immunity, for example, which is what pharmaceutical industry has been pushing for, right? That at some point in time, it will be safe for everyone to start walking around without their masks. I saw the South African government, where I am, talking about something similar as well, right? About reaching a specific target and then doing away with all these COVID restrictions. When we get there, which to me specifically is the second financial quarter of 2022, we are going to get a crazy boom, a massive boom in the markets, right? Because everything is going to go back to being open. Hotels are opening, travel is opening. And by the way, a lot of those weird companies that are required to recover or start to boom a lot of them are your small cap businesses. Remember, Facebook has been doing very well in terms of its functionality, right? The stock is down, I know, but Facebook didn't stop working because of COVID. We all had social media. Amazon was a preferred go-to due to COVID, because instead of going to the shops to flood the shops, you could get your stuff online and get it delivered to you, right? So those companies, mega caps that were functioning a lot during COVID, were slowly starting to make way for small caps that actually require the markets to actually open up fully. And I would be very mindful of that stuff. So for me, in absolute conclusion, I think we are now at the bottom. I personally believe we're at the bottom. This changes only if a war starts. But I personally believe we are finally very much close to a bottom. Now, the only thing that we need to look out for this week is how NASDAQ is going to do, how our tech stocks are going to do. Is it going to cross over here? Is it going to close just above 15,200? That might be a big stretch for NASDAQ, but let's see. Right, if it does close above 15,200, that means there will be a short squeeze. So people selling might actually get liquidated, right? Personally, I've locked profits just above this area and I'll get kicked out. I won't be selling again. I'll just be watching. I am interested to see markets cross over, like I said last time, this first supply here. That will be interesting because this supply took out a demand at about 14,500. So if it can take out a 14,500 demand, I'm excited to see where price will go. But if it doesn't take out a 14,500 demand and price starts to bounce back and then move back down to the downside, right, then we know something has happened. Maybe the oil panic is back. maybe, I don't know, Biden does something stupid. But for now, I'm looking at the bottom, right? I want to be very careful with my words, but I think we're starting to see a bottoming out. Number one. Number two, what we need to constantly see throughout the week is for the Russell to slowly just maintain, gains and slowly start to outperform week in, week out, right? And if the Russell can lead the stock market out of that, then we'll start to see a follow the leader effect as these mega cap companies start to come back. All right, but for the most part, I think I've said everything I want to say. Charts to look at every single day of your life before you make a single decision. As usual, DXY on the H4 time frame, institutional supply has now been taken out. Is this surprising? No, it is not. We spoke about this many times, right? Price is thirsty, who requires that it keeps going up, and there she is. They took out a supply. We might get a drawback now, right, into this area. That's fine. AUD USD, a swing trade that we're all in together as an academy, right? As DXY plays mind games, we might get a push here. Those of you who are not in AUD USD, I want you to hear me out very carefully. You missed the main sell, number one. Some of you have already taken profits, which is very good. You should have. I spoke about that in the public Telegram group. Those of you who are still holding and are perfectionists and you want your actual TPs hit, I've got one position like that still running, right? And I think our take profits are somewhere all the way down there. Look out for that. If dollar continues very hard, then this is a good place to sell. On the 1 hour, it looks very good. When you start to do a reverse multiple time frame analysis, be very careful because we still got the makings of an arrow, right? So maybe today and tomorrow throughout the Asian session up until London session tomorrow, if price could at least give us 1 or 2 red candles and trade a little bit sideways and start to show healthy distribution, then I'll be more excited to take this sell here. Because remember, on H4 and stuff, this is it, right? This is how big this sell area is. So we're very close for price making a touch there. Could be a very good place to make a retracement. It could be a trap, right? Where it looks like they're going to sell and they don't. If you look carefully on the daily, just so you're clear, because I'm not so sure if you're not in the sell with the academy because you're not a student, and you don't have access to all my pending orders that I put in here, or that you just missed it because your broker had a tighter spread or a bigger spread and you missed it by a few pips. But if you're not a student of the academy, I just want you to know that there also is no confluence in here. There is none. All right, there's literally zero confluence with the daily, etc. So it is quite a risky trade to take if it's your first time selling in AUD USD. It's a risk that you must be willing to take, right? I am happy to add to another position here. Why? Because the 5% I'm going to risk is 5% of profits I'm already holding, so my capital is not affected. All right, so just think through this, but this is going to happen by London session tomorrow, if not in the middle of the night in the Asian session. I don't know. From a daily perspective, it would be nice if this was a 365 candle being formed, okay, which will be a PCP pattern, and then tomorrow we begin the process of filling this wick, right? It's not always the case. This could be the beginning of a massive reversal. It wouldn't make sense to me, but anything is possible, right? This is not the market. When you get this type of candlesticks and these massive rejections, it always indicates a price reversal, right? But you can get them in the middle of a trend, and all of that could mean nothing. All right, so we'll see tomorrow. Ladies and gentlemen, this is all I have for you today. Thank you for tuning in. I hope that helped. So I think we're in the process of a bottom. A bottom is coming, and I think we're going to see a strong recovery within the next 30 days. All right, within the next 30 days, we'll see, right? In the next, remember, for a bottom to be a bottom, you want to see a strong V-shaped recovery. You want to see markets fully create a bottom, a base where they're not going to go down, and then to start building these demands to defend that bottom. So I think it's going to be a 30-day period, which is to indicate that the crisis might be over, the big crisis, right? As fear slowly starts to regulate, right? Those of you who are good with option calls, puts and calls, I would jump in. So I did a few of those today, you know, but my contracts are for about the next 60 days. But I'm thinking we are looking at about a 30-day bottom. Right, I appreciate you. Thank you for sticking around. I said 30 minutes. I spoke for an hour. Shake my hand, everybody. Have a beautiful good night. Let me know if this helped you in the comment section. Yeah, and cheers. Goodbye, everybody. Goodbye, everybody. I'm going to end the stream now, guys. Cheers. Pleasure, guys. Pleasure. Don't forget to like the video.